Why does Trump want lower rates? Well, because high interest rates slow down the economy. Businesses borrow less, stocks struggle, people stop spending as much, and for Trump, who loves growth and hates anything that makes America look weak, they're a problem. It's not just about making the stock market go up, it's way bigger than that. The US government is drowning in $36.5 trillion of debt, and when interest rates are high, the cost of that debt goes through the roof. Think of it like a massive credit card bill. Imagine you owe $36,500 and your credit card company charges 10% interest per year. That means before you even start paying down the actual debt, you're being charged $3,650 every single year just in interest. Now imagine the credit card company suddenly slashes the interest rate to 3%. Instead of paying $3,650 per year, your interest drops to just $1,095 annually. That's a saving of $2,555 every single year. Now you can put this money towards actually paying off your debt instead of just keeping up with your interest payments. Well, that's exactly what Trump might be doing, but on a $36.5 trillion scale. If the Fed lowers interest rates, the government can refinance its debt at a cheaper rate, saving billions, if not trillions, in interest payments. This wouldn't be the first time something like this has happened. If Trump can create that opportunity on purpose, it could go down as one of the smartest economic power moves in history. If this theory is true, we're not looking at a long-term economic collapse. We're looking at a temporary shake-up before a massive rebound. So you're probably wondering, how can you benefit from this crash? Well, you need to understand that stock market crashes aren't rare disasters. They're a normal part of investing. Every few years, the stock market takes a hit. People panic and headlines scream, the end is near. But history tells us a different story. Every crash of the US market has been followed by a recovery. The people who panic and sell usually lose money, while the ones who stay calm and invest strategically often come out on top. Instead of freaking out, this is the time to prepare, make smart moves, and hopefully set yourself up for massive gains when the market bounces back. Look, I'm not a financial advisor. However, I have made millions during stock market crashes, so here are my thoughts on what you can do to prepare. Step 1 is to invest while the market is down. Before you even think about investing, you need a rock-solid financial foundation. I know I've said it before, but it's worth repeating. That means building an emergency fund of at least 3 to 6 months' worth of living expenses and eliminating any debt with an interest rate above 8%. Assuming you've done that, if you've never invested before, this could be one of the best times to start. Stocks are essentially on sale. During the 2008 financial crisis, I was still investing at the bottom and saw my investments double within a few years. However, many of my friends panicked and sold, locking in their losses and missing out on the recovery. No one can perfectly predict the exact bottom of the market. But if you invest consistently while prices are low, you'll be buying assets at a discount. If you want to get started, then Trading212 are currently giving you a free fractional share worth up to £100 when you use the code Tilbury in the app and fund your account. If you've been waiting for a good time to do this, then this could be it. I'll leave a link in the description below if you're interested. Step 2 is to stay disciplined and think long term. Market crashes aren't random, they follow predictable cycles. There are 3 types of crashes. Corrections, which is a 10 to 20% drop. These happen frequently and are part of a healthy market. Bear markets, which is a 20 to 40% drop. These happen every few years and last about 289 days on average. And full collapses, which are more than 40% drops. These are rare, but have historically been followed by huge recoveries in the USA. The biggest mistake new investors make is letting emotions dictate their decisions. When stocks drop, fear kicks in and people sell at a loss. When stocks rise, greed takes over, and then they buy at inflated prices. This cycle is why most people fail at investing. So if you're already investing, the worst mistake you can make is panic selling. Selling while the market is down locks in your losses and keeps you from benefiting from when stocks recover. Instead, consider increasing your investments while stocks are cheap. Stick to a long-term strategy like dollar cost averaging. Invest in a fixed amount every month, no matter what the market's doing. This reduces the risk of buying in at the wrong time and ensures you're steadily building wealth. Remember, the best investors see downturns as a chance to buy more. Step 3 is to diversify your investments. Putting all your money into one type of investment is a recipe for disaster. The key to surviving market crashes is diversification. This means spreading your money across different types of assets. My portfolio includes stocks, bonds, precious metals like gold, real estate, and even cryptocurrency. It's also worth considering dividend-paying stocks, as they actually perform well during downturns because they generate passive income even when prices are low. Just remember, market crashes aren't the end of the world. If you understand how to navigate them, you won't be the one panicking. You'll be the one taking advantage of the opportunities while everyone else is running for the exit. This isn't the time to fear the market. It's the time to prepare, invest wisely, and stay patient. The ones who make the smartest moves now will be the ones who come out on top when the market rebounds. If you want to know how to invest in 2025, then I'm going to leave that video right up there. But don't click on it just yet. Make sure to subscribe if you want to grow your wealth, okay? I'll see you over there.